This is our Forex blog for April 24th, 2012. And like most days, we want to buy the strong ones versus the weak and sell the weak versus the strong. This is our build your own trend live only currency meter. It only works live. And what's nice about it is it also works on range charts. So the more active the markets are, the more they're moving, the more bars you have, thus the more granularity and it just increases your intuitiveness of what the most likely future direction is going to hold. This is using the build your own trend histogram, which allows you to set your own settings and weights. Most people use the ones that we've back tested and use ourselves. 15% weight for the very fast 5-minute trend candle, 15 for this one that measures the percentage of currencies above the 15-minute bar moving average. And the majority of the tools measure the percentage of currencies going up or down. The bottom two measure the intensity. It's kind of like force equals mass times velocity. The mass is really, you could consider the percentage of currencies going up and down, and the velocity is the intensity. If you got a 100-pound guy running 3 miles an hour, it's not going to hurt you if he runs into you. But if you got a 300-pound guy running 6 miles an hour, he's going to knock you over. And same thing with the markets. The more mass and velocity, the more likely the trends are to continue. And we average those together into a very easy reading histogram. Red is weak, green is strong. Anything added above the 80 level we consider significant. And underneath that I'm measuring, this is something I've added to the software this week. The old power index, I've reduced the height of the bars so that and also gave them the same colors as our pivot score. So we have the percentage of currencies above or below the 15-minute bar 20-period moving average, the percentage of currencies above or below the hourly, which is very significant. Typically, if most currencies are underneath the hourly, the trend's going to be down. And then underneath that, we have the daily trend, weekly, and monthly. Trends change first on the real-time basis, and then the 15th, and then typically the hourly, then the daily, then the weekly, then the monthly. So depending on what time frame trader you are, you can, if you're a longer-term trader, you can get rid of these and not use them. If you're a short-term scalper or someone like myself who likes to be in trades for 30 minutes, an hour and a half, and looks for 20 to 50 pip moves, then you're going to probably want to have them. Seeing that, our live tools also, by the way, start working when you put it on the chart. So having this on here lets you see that there was a strong trend, and then the 15-minute trend, the vast majority of dollar pairs were going down, and then at this point right here, the hourly shifted down. And so when you see some real-time weakness coming in, you have perspective there. And the daily trend and the weekly trend and monthly trend is still up, but knowing that a very high percentage of them are down, basically what I've done is, what do you do if the daily, weekly, monthly trends up in the case of the dollar here? However, and also the yen. Notice the daily, weekly, monthly is very strong, but you have a lot of weakness right here. A very high percentage of yen pairs are falling, and then at this point, the longer-term hourly shifts down, but the daily, weekly, monthly is still up. So you can trade the yen to the downside now today with a lot of confidence, a lot of security in that this trend's likely to go down because you have blood red right here. It's not light red like this pink, kind of like a light pink here, which is insignificant. It's blood red. And even though the daily, weekly, monthly is still up because they take longer, more time to change. The real time trends sometimes continue and other times they reverse. Today is a reversal in the dollar and the yen. So we want to sell those currencies today, and by adding this new component to this, you'd have a lot more confidence in selling the dollar and the yen. Now, what do you sell them against? Well, you want to ideally sell them against the strongest ones. The pound has strength today. These short-term intraday time frames are also up. The daily, weekly, monthly is up. So myself personally, I like when all the time frames are in one direction on one currency, and a decent percentage of them are weak in the other currency. I'm going to personally, myself, I'm going to risk my money, my family's money, on the highest odds trade, which in this case is the pound. I want to buy the pound yen. Strong pound, weak yen. It's as simple as that. We're going to bring that up right now and show you, some of the entries. And let's also look at the time that it showed up. The yen right here at 2 o'clock started to have some weakness. 15-minute trend went down, and right here the hourly shifted down at 4. So I'm going to go light into buying the pound yen at 2 and very heavily a lot more lots after 4 because even more time frames are up. Let me bring up our range charts. This is a 6 pips per bar range chart. And so here's 2 o'clock, right around here, it's 2:18. Here's 2 o'clock. You can see how early into this trend our tools picked it up right here. I mean, actually a few minutes before that. 2:03, right here. So, you know, a lot of times I'm not going to be buying the breakouts from the low, but I am going to look for a pullback once I know a trend has happened. And here it is gone up. Here's your first pullback. This is where I typically will get into the trade. And I don't know that this trend's going to continue. All I know is that it's likely to continue. The next resistance area where it's likely to stall is up here at the hourly, right here at 71. I'm going to get in this at 55. I have a 16 pip profit target, and my stop's going to be just a pip underneath this bar's low. This is a 6 pip per bar range chart, so the bar is 6 pips. I know that. And this is how I keep my losses small. And that's really the only secret to trading. Small losses, big wins. And by using a currency meter, you're more apt to find trends that continue. And you can see that this went up from about 55 all the way up to 25 almost. Right? 70 pips up. Now, you're not going to catch all those 70 pips. Maybe you got in this, made 15 pips, bought this pullback. You know, maybe you got out of that with a small loss, went back above the hourly here, you went in. I always draw my fibs after I get a decent sized wave. If I were to buy this right here at 72, I would be looking to get out here, but it shot right through the monthly pivot, went right up to the fib target. And wicks oftentimes are reversal patterns on range charts. So if I see it shoot through this, I'm almost always, probably 95% of the time, going to get out to 1.618. The fact that it stalled here, I probably would have exited half. Yeah, because sometimes it kind of stalls and goes sideways and then makes another thrust up. In this case, it pulled back. So I would have been out of half at 92, half probably somewhere around 98. You know, so my average exit somewhere around 95. This last trade right here, I would have been at 72. So that's 23 pips. Now, a lot of new traders, I can't tell you how many times it really annoys me that new traders say, well, I want to catch 50 or 100 pips a day. And that tells me immediately that they've never traded before, or they are very much a losing trader right now. I know that for a fact. If you traded for a while, you'll know that 10 or 20 pips a day will make you a lot of money. And in fact, we've added a tool in here that lets you kind of see what your account will grow to if under certain circumstances. Here's a $2,000 account, 10 pips per day net. Now keep in mind, 10 pips a day is 50 a week, 200 a month. 200 net pips per month. That means you might make 500 pips and lose 300 pips during the month. You know, your losing trades add up to 300 pips of losses. Your winning trades are 500 pips of wins. You've netted 200 pips. So basically it means your account grows pretty much, it doubles every 2 months, every 8 weeks. You can see 2,000. 4 months later is 8,000. 2 months later is 18,000. And obviously this is compounding. You keep increasing your lot size. At the end of the year, you have a tremendous 258,000. You have to trade 51 lots at a time. Most people, once their account gets to a certain size, they just take money out and put it in longer-term investments. And most of us trade for a living. That just take money out at the end of the month, live on some, save most of it. Tax rates are very advantageous for traders. You don't have to pay Social Security taxes on it. And there's ways to minimize your tax bill too. But we don't ever answer questions like that because we're not tax attorneys. But nonetheless, 10 pips a day is all you need. So you bought it right here. Oops. Bought it right here when it went back above the hourly at 73. This is all you needed to get your 10 pips per day is right here. So keep that in mind. Now, a lot of people don't have every day to trade. So if you want to trade 3 days a week, you might need 15 pips or 18 pips a day. If you're only going to trade 2 days a week, you need 25 pips a day to have those same kind of results. So, but you can see with this software, you knew to be trading this, and after 4 o'clock, you're even going to get even more aggressive in this. And here's 4 o'clock, so I might have done a little bit more. This has already moved a considerable distance, though, so I might have decided not to really get aggressive with this. But you want to know where your fib is. So, again, in this trade, maybe with more lots right here at 05, out at 15 pip profit, I probably would have got out of 2/3 of this trade because it's already gone up one wave, 2 waves. This is the third wave. A lot of times 3 waves is the end of the move. One of the things I like about range charts is if you find a strong currency, 3 to 5 red bars, and anywhere up to 8. The first green bar you get, you buy it when it goes 1 pip above the high, and you put your stop right underneath the low. So you're risking less than 10 pips. You're also, as you can see in this, the trailing stop quickly moves to break even, usually within 1 or 2 bars. And anytime it comes up to the high and really can't break it, I'm going to get out of half my trade when it comes back down underneath here. So I probably would have been out of half my trade here at 17, in at 05, and then when it goes sideways like that, I'm putting my stop underneath here. It could continue up, and if it does, more likely I'm going to draw my fibs and get out of that fib target up there, which probably is somewhere at 131, 35 to 40. But nonetheless, again, you made more than 10 pips on this last trade. And a lot of times when you have a strong currency like this, one of our methods is the Elliott two-way fib pullback. You draw your fibs off of this, and somewhere between the first and second fib target, this one is a cluster of support because it also has the monthly pivot. That's the average price of the previous month. And also you can see 1, 2, 3, 4, 5 bars down, 1 green bar, you're in right here, and my stop is going to be underneath. Usually in this case I'm going to put it right underneath the 1.618 just to give it a little bit of room. This Elliott two-wave system, from my own perspective, is a little bit around 70% or more winning, especially when you have all the trends up. And at that point, you can see it went up, came back down, starting to go back up. I'm moving my stop up here. I'm going to only risk 4 or 5 pips at this point. It's kind of going up and going sideways. I'm going to move my stop, underneath these bars low. And then when it comes up to this high, you can see wasn't able to get above it. So I'm probably going to get out of all my trades somewhere around here and give up on it at 131.10. I'm in this trade at 94. That's 16 pips. Again, more than 1.6 days worth of minimum profit. So let's look at one other example on this. Dollar and yen are weak. You can see the euro is strong. A very high percentage of currencies, even before today started, were above their 15-minute moving average. The hourly, more euro pairs were above their hourly moving average and beneath it. The daily trend shifted up. The weekly trends meagerly up. So obviously you want to buy the euro dollar and euro yen. So let's just quickly show the chart here. You can see a little breakout of the daily pivot right here. Went up about 20 pips. It kind of went down and went sideways. You buy this breakout right here, you would have had a loss. Pull back to the hourly, and you can see that weakness quickly ended. I probably would have bought it right here when it went back above here. Went up 15 pips. Pull back again. You have the 10-day moving average underneath there. When it goes back above the hourly, you go long. Our IntelliTrend bars go green, and that one was a home run. It went up 40 pips. So look at the euro yen. This one came down, found support at the previous day's low. You don't really want to buy down there until you get some signs of strength. This is kind of a 1, 2, 3 low. Anytime it finds a low, barely moves up at all, and then on the way down has almost no weakness compared to before, usually that's going to reverse. So when it breaks out right here, you might go long, and you can see it went from 50 all the way up to 09. It went up 60 pips. Even if you got out of 10 here, made 10 here, made 25 here, you bought this pullback here, you maybe lost 10. You bought this breakout here, you lost 10. Pulled back down again, went back above the hourly, got in here at 70, and it just kind of shot up. I probably would have got out right here near the high because it seemed to have trouble getting over the high. I wouldn't have caught those extra 20 pips myself. I know myself. Here's what it looks like on a range chart, which I think is even more clear. By that pullback here, notice this here. Remember, 3 to 8 bars of red. First bar green, you buy it. Now, what if it goes above this bar's high, which it really seems like it might have. It's hard to say. But let's say you got in here. You lost 10 pips. Another 3 bars back. You're in here at 62. And the trailing stop had you out here at 94. So you lose 10 pips and then make 30. Big deal. And that's typically what happens. What if you're trading, during the U.S. session? Well, the dollar and the yen are weak. The dollar is weaker than the yen, as you can see here. And, the dollar went back to some weakness here around 9 o'clock. This one still has a little bit of strength, or actually quite a bit of strength. The hourly was, relatively strong too. So I would have, in the U.S. session, focused on the dollar. And the pound is no longer strong, so we're not going to be buying the pound. The euro and the Swiss. So we want to sell the dollar Swiss during the U.S. session. Let's bring it up. Notice, 9 o'clock right here, you knew about it. It broke down. It fell from 91.20 all the way down to 94. Fell 25 pips. Here's what it looks like on the range chart. And the dollar Swiss doesn't typically move as much as some of the other currencies. But notice how looking for a 3 to 5 bar reversal can really pay off. You were looking for sells, and at 9 o'clock right here was right around here. You had 4 bars up, 1 bar down. You sell it when it goes 1 pip below the low. And this is the main reason why I love range bars. It fell a very nice 35 pips. And if you looked at this one here, green, 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 3 bars up, 1 bar down. You go short right here at 32 with your stop above the high. It pulled down to 23. It fell 10 pips. So that's more than enough to move your stop down to break even, or if you used our trailing stop, you're probably out somewhere around here at 34. You're in this trade at 32. You lost 2 pips, maybe 2 pips spread, 4 pips. 4 pip loss is nothing. If you can't make money with having 4 to 6 pip losses and occasionally catching 20, 30 pip wins, you really need to quit trading. And I've built our software around doing that, having tiny, tiny losses, which makes it psychologically easy to pull the trigger again. If you just lost 5 pips and you had 8 pip loss before, you're down 13 pips, you know that there's usually one nice move you're going to catch if you trade for a couple hours. Hopefully it's 20, 30 pip win. You're at either break even at the end of the day or maybe up 10 or 12 pips. And then some days you're not going to have those 2 or 3 losses before you catch a big win. You might catch a 10 pip win and a 30 pip win, end the day up 40 pips. Hopefully you trade more lots on winning days like that. Or if you have a couple winning days in a row, trade more lots. Use the market's money to leverage yourself, and on bad weeks trade small so that your losses don't compound and get super huge.